If you are a Canadian senior over 60, stop what you are doing. There is a quiet rule change in 2026 that could be costing you up to $87,000 in lifetime retirement income, and almost no one is talking about it. The Canada Revenue Agency has updated how RRIF withdrawals work this year, but most retirees are still following advice from 2015. They convert their RRSP to a RRIF at the wrong age. They withdraw the default minimum. They trigger the OAS clawback they never saw coming. And by the time they realize it, it is too late. Stay with me until the very end, because I am going to walk you through exactly how to avoid this $87,000 mistake in 2026. Here is exactly why this is happening right now. CPP and OAS alone rarely cover a comfortable retirement in Canada. Most seniors also depend on private savings held inside an RRSP. The federal government has a rule. By December 31st, of the year you turn 71, your RRSP must be converted into a RRIF, a registered retirement income fund. A RRIF forces you to withdraw a minimum percentage every year. That minimum starts at 4% at age 65 and rises to 6.82% at age 80. By age 90, the government forces you to pull out 11.92% of the account every single year, and every dollar you pull out is fully taxable income. Add it to your CPP and OAS, and you can easily blow past the OAS clawback threshold. In 2026, that threshold sits at $95,323 for payments received between July 2026 and June 2027. Every dollar above that reduces your old age security by 15 cents. So a forced withdrawal of $20,000 in 1 year can quietly erase $3,000 of your OAS. That is real money, gone forever, every year you take too much. Let me explain what the government has set up for seniors like you and how to keep more of it. The first mistake is converting too late. Here is what most Canadians do. They keep their money inside an RRSP as long as possible. The bank sends a letter at age 71, they sign a form, they open a RRIF on December 28th, and then the problems begin. That is because the moment you open a RRIF, the government forces a minimum withdrawal the very next calendar year, regardless of whether you need the money. According to the current prescribed factors published by the Canada Revenue Agency, the minimum payout is 4% at age 65, 5% at age 70, 5.28% at 71, 5.53% at 73, 5.82% at 75, and 8.51% at age 85. If you wait until age 71 to convert and you do not need the cash, every year that follows pulls out more. Take a $500,000 RRSP converted at 71. Your first year minimum is $26,400. Add CPP, add OAS, and a single retiree in Ontario with no other income suddenly finds herself in the 30.5% combined marginal bracket. Margaret from Mississauga, Ontario, held off on converting until the deadline. Her first mandatory RRIF payout pushed her over the OAS recovery threshold. She lost $4,200 of OAS in a single year because she never knew she could have converted earlier on her schedule with smaller early withdrawals. The fix is simple. You can convert an RRSP to a RRIF at any age. There is no law that says you must wait until 71. Opening a RRIF at 65 lets you control how much comes out, and it unlocks the $2,000 federal pension income amount on line 31400 of your tax return, a non-refundable credit worth up to $300 every year. Many provinces, including British Columbia, Alberta, and Saskatchewan, also offer a provincial pension income credit on top of that. Do not go anywhere, because what comes next is even more important. The second mistake is withdrawing the default minimum without thinking. The RRIF minimum is a floor, not a target. It is the smallest amount the CRA will allow you to take out. Every dollar on top of that is a choice. And most Canadian retirees never stop to ask whether they should be taking more or less. Here is why this matters so much in 2026. RRIF withdrawals are added on top of your CPP, your OAS, and any private pension income. They are reported on a T4 RRIF slip and taxed as ordinary income. Withholding tax is taken off at the source. Outside Quebec, the withholding is 10% on amounts up to $5,000, 20% on amounts from $5,001 to $15,000, and 30% on anything above that. Those are just prepayments. Your real tax bill comes when you file. If your only income is CPP and OAS, and you withdraw an extra $10,000 from your RRIF, you could owe another $1,500 to $2,500 in April. Worse, that extra $10,000 can also push you above the $95,323 OAS threshold and start clawing back benefits you already earned. A senior in Victoria, British Columbia, a widower named Harold, took his full RRIF minimum at 73. He did not need the money. He did not realize the extra $14,000 a year would trigger $2,100 in lost OAS plus higher provincial tax in BC. His total hit was $3,400 a year, every year. The smarter play is to take only what you need, top up with the GIS if you qualify, and leave the rest invested. The money still grows inside the RRIF, tax sheltered, until you draw it later. Keep watching, because the next point could save you even more money. The third mistake is forgetting about pension income splitting. This is one of the most overlooked tax tools in Canada. If you are 65 or older and you receive eligible pension income from a RRIF, you can elect to split up to 50% of that income with your spouse or common law partner on your tax return. You do this on Form T1032. The election must be made every year on time by the filing deadline. Splitting income moves dollars from the higher earning spouse to the lower earning spouse. Both spouses end up in lower tax brackets. Both spouses may qualify for new credits, and in many cases, the lower earning spouse stays below the OAS clawback threshold, protecting thousands of dollars of pension. According to Canada.ca, eligible pension income includes RRIF payments, life annuity payments from a registered plan, and certain registered pension plan amounts. It does not include CPP or OAS. So a couple in Winnipeg, Manitoba, where both spouses are over 65, can shift up to 50% of one RRIF to the other each year. A typical household saving is $1,200 to $2,800 per year, depending on the gap in incomes. Eleanor and Grant from Fredericton, New Brunswick, split $18,000 of RRIF income last year. Their combined federal and provincial tax dropped by $2,650, and Eleanor's GIS payment stayed protected because her individual income stayed low. This election costs nothing. There is no fee. You do it on paper, but most retirees never do it because they do not know it exists. Or they file taxes through software that does not ask the right question. Stay with me because most people give up right here and miss the biggest savings. The fourth mistake is ignoring the age amount and the pension income amount together. Most Canadian retirees over 65 qualify for two non-refundable tax credits that stack. The first is the age amount, currently worth up to about $1,290 federally for 2026, phased out between roughly $46,400 and $107,800 of net income. The second is the pension income amount, already mentioned, worth up to $2,000 federally. The age amount is automatic for those who qualify. The pension income amount requires RRIF withdrawals to claim. If you keep your money sitting in an RRSP past 65, you are forfeiting both. Every dollar of RRIF income you draw increases your total return, but it also unlocks that $2,000 credit. The federal credit rate for 2026 is 14%. That means the maximum federal pension tax savings alone is $280. Add the provincial version in Ontario, which is up to $174, in BC up to $190, in Alberta up to $200, and the combined saving grows. So a small, controlled RRIF withdrawal of even $2,000 a year can produce a credit that more than offsets the tax owed on it. A retired school teacher named Donald from Red Deer, Alberta, started drawing $4,000 a year from a small RRIF at 65, even though he did not need it. His net cost after the combined federal and Alberta credits was under $60 a year, and his tax return stayed clean. This is the kind of move that turns a forced withdrawal into a strategic withdrawal. Hold on, because this one shocks almost everyone who sees it. The fifth mistake is letting the RRIF keep growing into higher brackets. Every year you delay taking taxable income from your RRIF, the account balance grows. And because the minimum percentage keeps rising with age, dollar amount of forced withdrawals climbs sharply. At age 75, the minimum is 5.82%. At 80, it is 6.82%. At 85, it is 8.51%. A $400,000 RRIF at age 80 forces a withdrawal of $27,280. At 85, that same account, if it grew to roughly $420,000, would force $35,742 out. That jump in income does three harmful things at once. It pushes you into a higher federal and provincial tax bracket. It can trigger more OAS recovery tax above the $95,323 threshold. And it can disqualify you from the guaranteed income supplement if you are a lower income senior, because GIS requires your taxable income to stay below roughly $22,512 if you are single in 2026. The fix is not to refuse withdrawals. The fix is to smooth them out across the years. Take a portion every year, split it with your spouse. Keep individual income near, but not above, the OAS threshold. A retired couple, Linda and Pierre from Gatineau, Quebec, took control of their RRIF at 70. They withdrew a fixed $24,000 a year, split it evenly on Form T-1032, and paired it with their combined CPP. They never crossed the OAS clawback line. They never lost the Quebec tax credit for living seniors. They preserved over $60,000 in lifetime benefits, and they avoided the bracket jump that would have cost them another $4,000 a year in tax. That is the $87,000 mistake, played out in real numbers across a retirement. Keep your eyes on the screen because the final point on this list is the biggest. Here is exactly what you need to do right now. First, log into your CRA My Account and pull the last 3 years of your T4RIF slips. Second, calculate your projected RRIF minimum at age 71, 75, and 80 using the prescribed factor chart. You can find it on the Canada.ca page titled Chart Prescribed Factors. Third, decide whether to convert your RRSP to a RRIF before age 71 so you control the timing and unlock the pension income amount. Fourth, talk to your spouse about pension income splitting on Form T-1032 and make the election every single year on time. Fifth, revisit your withdrawal plan every January because the OAS threshold, the GIS thresholds, and the RRIF minimum percentages all change with inflation and age. These 5 steps alone could save you anywhere from $20,000 to $87,000 in lifetime retirement income, depending on the size of your RRSP and how long you live. Do not wait. Start today. These 5 points alone could save you between $20,000 and $87,000 in lifetime retirement income, and in any given year, up to $4,000 in tax and loss benefits. This is money you have earned, money the government is letting you keep if you act, and money that belongs to you and your family. If this video helped you, hit the subscribe button right now so you never miss another update like this. Tap the bell so YouTube shows it to you the moment it drops. Give this video a thumbs up so more Canadian seniors can find it, because most of your friends and your neighbors do not know any of this. Share this video with your spouse, your siblings, your bridge club, your church group, and anyone over 60 you care about. One share could be worth thousands of dollars to someone you love. I will see you in the next one. Take care of yourselves, take care of your money, and I will see you soon. Disclaimer: this video is created for educational and informational purposes only. It should not be considered legal, financial, or government advice. Eligibility for exemptions, credits, pension income splitting, and OAS recovery tax may vary by province, income level, age, and personal circumstances. Always verify all information through official Canadian government websites, Service Canada, the Canada Revenue Agency, or qualified financial and legal professionals before making any financial decisions.